All right, so we got that. We got this in the way. I got my drawing tool. The chat's working. Let's go. Bees? Sure. Oh, right on, Amelia. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but cheer up! And stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Good morning. I apologize for being late and tardy. I'm up. I'm awake. You can see I even shaved. So, you can take 1, 2, 3, shaved. 1, 2, 3, shaved. Wait, no, that's not true. So anyways, good morning, everybody. Happy weekend. I hope you did something awesome. My daughter went whitewater rafting. I didn't. I did homework, so that was really cool. You up to anything cool? Huh? You doing anything cool? So I'm looking forward to a really great trading week. We'll have to go through all the pairs today. We'll look at the yen pairs, dollar pairs, gold, oil, Bitcoin. I'll go around the world this time. The last week or so, I've been sticking more to trading techniques and fundamentals. But in this case, we'll just go through and see if anything's happened over the last couple of weeks, right? We'll watch a couple of weeks, see if anything happened, and we'll see if we can discern whether anything will happen. So that's the whole thing. Really, we're trying to see if anything from your Thursday trade planning is fulfilled. But last Thursday, we just did all fundamentals and didn't even plan any swings. There you go. That shows you that's the proper technique, huh? So anyways, get involved, ask questions. Okay? This is your opportunity to sharpen your saw. See, you're part of the Forex trading community we call Forex.Today. 14,200 foreign exchange traders stationed all around the world. Now, imagine the power, the alpha of all our minds put together. Resistance is futile. Yeah, we have a real opportunity to be something really good and really powerful. It's the greatest group of all time. What else? Oh, thank you, Traders Way, for being our sponsor. TradersWay.com. Go to TradersWay.com, open up a demo. When you're in the back office, download MT4 or MT5. Set up an ECN account, a fixed spread account, a variable account, whatever you want. Place some trades. You'll go, ooh la la! Execution speed's fast. Oy vey! Look at those swaps. World-class customer service, knock your socks off. TradersWay.com. Thank you, Traders Way. Now, these webinars cost you no money, but they're not free. If you benefit in any way, even if it's just a chuckle once in a while, then you must go to TradersWay.com and open a demo account. And then one day, if they earn your loyalty and respect, please fund your account with real money. Let them be the execution partner to your successful Forex trading business. Okay, here we are. Let's start by looking around here. Goldie, 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 goldie. So we spent some time sometime last week. You can see I said, this could be a buyer of a dipper in here. A buyer of a dipper. A buyer of a dipper. You could be a buyer of a dipper. And down, 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 down. Up, 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 up. Cool. See? All it takes is patience. So now you got two choices of what you can do. It's not a tough decision, as you can see. Okay, a bull is going to try to take it off that 21, and a bear already sold. If you didn't sell that already and you're a bear, you don't know what you're doing. Or you know what you're doing, but you're not doing the work. And both of those things are likely. Okay. So the way I look at it, if you were a bear on gold and the market opened on Sunday and you were right here and you didn't play a double top, either you're not doing your job, so you weren't there, or you didn't know what you're doing, so you didn't play a double top. And you're like, Wayne, how dare you? No, it's just how it is, man. Don't get all mad at me. Okay? So there's really, when it comes to gold, if you're a bear, that's probably your only chance this week to be a bear. And if you're a bull, well, it's the up, 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 down, roll reversal off the central kind of thing, and you're long and gone. Of course, maybe a Friday or Sunday open maybe in there, but that's doubtful. I mean, you could, but I'm not saying you should. I'm saying if you're a bull, you would have caught this now, right? So there's your basic sort of London Open scenario. And other than that, you see we're in the middle. And this is 50-50 now. Okay, you're either buying it off support, you're selling it off resistance, or you're a pig. Okay, is that too harsh? Kind of feels like a bitch slap, doesn't it? But you know, there's not a lot going on. We knew the volume and volatility would be low. We knew that, right? So the one thing you can rely on is entering your trades properly. The right price, the right time. That's what we've been talking about. Like you may not expect big moves in your planning. You still have to plan for them, but your expectations are much more humble. But right, and you can't control the volume. You can't control the volatility. But the one thing you're supposed to be doing is doing your job exceptionally well. So Sunday at 6 p.m. ET, yeah, on Sunday, you should be ready to pull the trigger, right? Okay? How many people know that as a factual statement, that that is your job? Okay? Okay? And if you were in my day trading course, we did that live for, oh, I don't know, and the swing trading course and stuff too, for I think a month and a half or 2 months, we actually met 6 p.m. Sundays, right? And the point was, you're there right at the open, ready to go. So a bull could have even bought this. They could have seen like, oh, they missed this, but then they bought this little dip. And that might have been their plan for the day. It's not the world's greatest, but you do it. Right on the open, you have permission. And even if you did, you're not super excited with the results so far, but you're at least break even, and you're in at a good point. And that's your trade plan for the week. There it is. You just planned your whole week out. So you show up Monday morning in New York, and I'm like, dude, you've been done for 12 hours, like, right? You see what I mean? Now the flip side of that, if you're a bear and it opens here, you're like, oh man, in the next 4 hours, I'm probably going to have a shot down. Because you were a bear here, and that's the whole point. You were a bear here, and last week you were gunning for a lower low, lower high. And then you see, well, this popped right at the close. So that really is an anomaly. It's, sorry, I can't speak English. And so you're like, well, so I'm going to set this up as a double top, and it's going to, you know, go back to what it was doing. Okay. Okay. Where would the stop loss be on this one? I think the question is right in here. Right in here. If it's a swing trade, if it's a day trade, you're probably, yeah, you wouldn't need much more than that. So you'd be, because the whole point on this part is your OOP. So according to the training course, if your OOP where is your buy? Where is your support, guys? If you notice at the open your OOP, what is the standard operating procedure to get in? OOP, by the way, is out of position. So what's the standard operating procedure that everybody knows? Yeah, dude, you buy there. Like, dude. So the problem is if you don't know, you don't know. But now you know you don't know, so what are you going to do about it? Right? When you're sitting there like, oh man, this was so confusing the last 16 hours, and then someone else says, it's so straightforward, it's boring. Then you should say, oh my God, I'm missing something. I need it. I need that. That's what I need. To say like, that was the plan. Okay? And that's a bullish trade plan faux show. Now, it doesn't mean it's going to go up. It means if you're a bull, you know exactly what to do, but really, honestly, before it's even happened. Okay? You know up here, you're out of position. At some point, it's going to come back to the 21. So whether it happens here or makes the high to the, let's say, R1 and then down, or makes a high up to the double top and then down, the whole time you're like, okay, I'm a bull. That's great. It's going to come back to the 21. I'm going to buy it. Done. So you're going to be along, you're guessing around 1764, 1765, whatever. Easy peasy lemon squeezy. Now the flip side of that, like I was saying, is you know it that you want to sell this if you're a bear on gold, and you didn't just suddenly become a bear on gold. If you suddenly become anything, if you suddenly become a bull or you suddenly become a bear, you are about to lose money. There's nothing sudden in these markets at all. These are, think of it, this is what we trade by and large are corporations and indeed countries around the world doing business with each other. There's nothing sudden about it. So if you just suddenly become bearish, you may have lost control of what you're doing. And that generally leads to inconsistent results at best and losing results at worst. Okay, so anyway, so if you were a bear last week, well, here's your second try again. Because you really wanted to sell it here and you go and get that down. That's a basic bearish swing trade plan, one of the most basic you can get. And then the only other bearish swing trade there is sell this and down. How many people can confirm that there's only two standard operating procedure bearish swing trades, and those are the two? How many people have gone through the course and can confirm that you would have known that those are the only two prices a bear would have ever even considered? Not even looking at the double top, just, like how to read piano sheet music, right? You look at it, you're like, that's a C note, and that's a C note. They're just different octaves, same note. Right? You see? So you look at it, and that's a low C, and that's a high C, but it's factual. And you can choose which octave you want to play it in. That's fine too. But a C is a C. Okay? High, and the only thing that changed was the octave, but you know what a C is. Okay? So that's that. So the cool thing is you have the freedom to decide based on long-term technicals or long-term fundamentals, whether you're a buyer or a seller. Okay? And so if you can grasp that, whether you're a buyer or seller, okay, then everything will get not easier, but clearer to you. Okay? Imagine going through the world and you don't know if you're a buyer or a seller. There's no way, absolutely impossible, that you will be a success. Okay? Thank you, Ronald. Okay? So my point with the sheet music is, it's just is. A C note is a C note. There's multiple C notes, right? This key is a C, B, 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 B. No, C, 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 C. C, 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 C. C, 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 right? But they're all C's and they're logical. So in this case, if you're a bear, there are two bearish trades. It's not an opinion. It's just fact. It's not my opinion what to call each note. A C note is a C note. A C sharp is different from a C. Okay? So anyway, so if you're a bear, there's only two things you should be thinking about today. And one of them has already appeared. Now, again, does that mean it's going to go down? No. It means if you're a bear, you would look to sell here. Doesn't mean you'll make money. But if you're not a bear here, you may be lost. You have a gap in your knowledge. You don't know what to do. Well, actually, you know what to do because you're a bear. You just don't know how to do it. You're missing something in your technical analysis, and don't worry about it, bro. That's easy. We can fix that. Okay? But if you don't know if you're a buyer or seller in general, you have no value to society. You're not contributing to productivity. You're just a liquidity event. Okay? How do you know if you're a bull or a bear? Long-term technicals and fundamental analysis. Okay. How many people know my bias on the US dollar? Don't say what it is. Don't say what it is, but you know for a fact I know I have an opinion on the US dollar. How many people know if I have a bias or not? Because it doesn't matter what it is, because the worst case scenario is other people do that just because I said it. Well, I don't know if I'm right, but I know I have a sellable point of view. Okay? Now, how many people know if I have a strong conviction based on some sort of, I don't know, evidential data? Like it's not a, in that case, it's not a flip of a coin. But Pat, it's just as good as a flip of a coin. But that I have some sort of logical, intelligent reasoning. Does anybody know if I do that? Okay. Okay, so now from that logic and reasoning, I have shaped an opinion. Now, we don't know if it's right or wrong because it's just one opinion out of a million. But the point is, I've done some sort of work to fool myself into one direction. Wow, that's a boy band, isn't it? Written on these walls are the stories that I can't explain. I don't know if that's One Direction. But anyways, it's a boy band song. So I have an opinion on this direction. She told me in the morning she don't feel the same about us in her clothes. Anyways, so yeah, so I have a conviction here. So it's helpful to me. Now I have half as many opportunities, but the interesting thing is my opinion on this asset, it doesn't even matter what it is, it's priced in dollar. And because of my bias on dollar, so I believe global growth will go up. I'll just growth. Okay, global growth will go up, which means consumption will go up. And hopefully, eventually, investment goes up. Okay? And this all together, via the US dollar, will end up with a trade going up, global trade, okay, which is imports and exports per country, okay? And all of that shapes what I think is going to happen with the US dollar. So if consumption go up, so right now on this asset class, I'm looking at consumption. Okay? And the theory with this is if there is global growth, consumption of everything will go up. Okay? You see what I mean? Okay? So consumption of everything. Is this a thing? Can you touch XAU? Let's translate XAU to gold. Can you touch gold? Can you hold gold? Can you carry gold? Can you put gold in a vault? Can you trade gold? Can you make things out of gold? You can actually put gold inside your body. That's one of the wonderful things about gold. Cool. So consumption of everything, well, this apparently is a thing, so consumption of that would go up based on my analysis. So someone said, how do you decide if you're a bull or a bear? That's one way of doing it. Nope. No, Marco, not really. How many periods you want to see pivots? Like, do you want to see a bunch of old pivots? You can do that. You don't really need to do it that way. Because really, you only care about today's pivots and tomorrow's pivots, right? Yeah. And of course, Marco, you might want to change if you're looking at daily pivots, weekly pivots, or monthly pivots, right? So, but all of that is pretty standard. Oh, my pleasure, Marco. Now, Daniel says, in a way, it doesn't really matter what your bias is because there's money to be made in both. Well, actually, bulls and bears need each other. So, Daniel, one way that I describe it is that we are taught that that Forex is a zero-sum game, which means I get mine and you get yours. And in fact, it's me versus you, killer versus killer, winner takes all. If I'm long this trade, you're short this trade, and only one of us is going to make money. Well, that may be true on that individual trade, but if you look at this more of a market concept, look at how many times bears made money. Okay? And the interesting thing is bulls need bears to do that so that they can do their thing. Bulls need the down so that they can buy the up. Now, the interesting thing is bears need the up so they can get the down. Because remember, bears sell high. So if no one ever buys it, the price will not be higher very often. You understand? And bulls buy low, but if no one sells it, it's not going to go low very often, because if everyone is buying it, it's much more likely to go up. The only time you get a dip is when bulls take profit and then they buy it back again. And then bulls take profit, then they buy it back again, right? But it's very helpful. It's beneficial. It's symbiotic that bulls and bears work together. So a bear can sell the high a bull would buy it. Bulls buy it up, and then bears take it down. Bulls buy it up, bears take it down. We each can take turns, like kids in a park playing with a toy. Rum, 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 rum. Okay, here you go, Mikey. Your turn. Rum, 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 rum. Right? We're sharing. We're sharing. My turn. Game on. So it's not a zero-sum war. You can look at it that way if you're a scalper. Sure. But I see it more of a dance. That we're working together. And when my left foot goes forward, your right foot goes back. And sometimes there's a lead, right? One person may be leading this dance because there's a trend involved. And then maybe on the next song, the other person will lead. Okay? But I look at this like, why would I be a bear? Okay. Now, the interesting thing, if you've been hanging with me, by the way, I was just on LinkedIn, and LinkedIn tells me that I started FX Bootcamp 15 years and 2 months ago. Cool. So, when I look back at 2017, I was there. Okay. And I remember going through this period. It was just sideways forever. Ridiculous. Pretty amazing, huh? Okay. So I'm getting closer and closer to 2 decades of trading Forex. Okay. It's weird that I'm studying venture capital again. I didn't really mean to. It's interesting to look back at what you used to do 20 years ago. And one of my textbooks is talking about, the Silicon Valley in the 90s and the 00s. And it's funny because I know the people in the firms like in the book, and I'm like, oh no, I'm that old now. But I remember being young and excited about it. It was good times. Yeah, Michael's is very wholesome. But Michael, I hope you appreciate the idea that bulls and bears actually need to work together. And I'm making a comment on someone else's comment, that ultimately it doesn't matter whether you're a bull or a bear because, so Daniel made it, right? There's money to be made on both sides. If you think of it that way, that you're working together, you're correct. I don't care if you're a bull or a bear. Both of us will be profitable at the end of the year if we do our job correctly. Now, one of us will be a lot more profitable in at the end of the year in most scenarios. I mean, some scenarios will be just as profitable, but that means there's no trend. But more often than not, one of us will be more profitable than the other. And it's not that we were better traders, it's that one of our biases was more appropriate for market conditions. And that next year you could kick my butt, but this year I won. Okay, but you see that? But I think the most important thing you could possibly do as a currency trader to become profitable is deciding if you're a buyer or a seller. In my book, I recommend that you pick one currency. So you could do something like, let's do this. You can say now until the end of your life, all you do is buy Japanese yen pairs. Done. Cool. Now I know what you do. Now you know what you do. So if you're incredibly consistent of buying yen pairs, right? Do you guys remember the statement? I think I asked you guys maybe 2 weeks ago. I said, if all you did was buy dips in an uptrend, would you be profitable? Would you answer that again for me? If the only thing you did, your one trick as a foreign exchange trader, is you bought dips in an uptrend. And if it's not an uptrend, you don't do anything. Would you be profitable? So here's the interesting thing. That's all I've ever asked you to do. So now you need to sit in a teepee with a peace pipe and figure out why you don't do that. If you know it's a universal truth, why is it that you don't do it? Or, I don't care about the uptrend. If all you did was sell rallies in a downtrend, would you be profitable? And the true answer is it's not very exciting. And for some reason, you were told Forex was more like Fortnite, where you can run around, pull the trigger all day, and it's going to be fun and exciting, and maybe you'll get a yellow Lamborghini, right? And really good-looking people will start laughing at your jokes. And then you find out, well, it's not actually true. So you might want to ponder what it is that you do. What is the reality? Okay? So, like, I'm studying venture capital again. And so if we were to compare venture capital to a hedge fund, there are lots of similarities and lots of differences. Okay? A hedge fund has to go out and raise money from rich people. A venture capital fund has to go out and raise money from rich people. Cool, right on. One has absolute returns, one has internal rates of returns. So what does that mean? What's an IRR? That's the return on the capital actually invested. Why? Because a venture capitalist rarely makes investments. 98% of the time they say no. You feel like you have to make 5 or 10 trades a day, every day, no matter what the conditions are. I think you should make 5 or 10 trades a day when the market conditions are ripe. Okay? So anyways, but here's how dumb venture capital can be. When do you know you're right? When you're a venture capitalist, you give this company $1 million, and then you give that company $1 million, then you give that company $1 million, then you give that company $1 million, and then you give that company $1 million, and you meet with the executive team 3 times a week. You might actually be the vice president of marketing, or you might be the co-CEO. You sit on the board. You got 15 companies. It's taken up your entire life, and you're inviting the portfolio CEOs to your house to make sure you have established rapport with them, and you're going out meeting the customers, and like it takes over your entire life. When do you know if you traded money for equity in the startup? When do you know you're right? 5 years, 10 years down the road? How crappy is that? How lame. How lame. It's gambling and it's betting, isn't it? Ultimately, I'd much rather have control over my destiny. Having a hedge fund is so much better. Having a hedge fund is so much better. What do you guys think? You're like, yeah, I think I'll move my stop to break even. No matter what, I'm going to make money on this. Or as you're sitting on something, you're earning income as well as capital appreciation. And then when you're like, you know what? I need out of this trade. It's bad. You hit a button and you liquidate instantly. How do you get out of a bad trade in venture capital? Well, you lost your $1 million. Goodbye, $1 million. Goodbye. Adios. Right? So I keep trying to get you guys to try to think more like professionals where, you know, are you an intraday trader only, or can you make investment decisions? Okay. Could you, if you're out raising money for your fund and that rich person is also thinking about investing into a venture fund, could you compete? You say, wow, venture capital is so exciting. I love it when you hear about some guy drops $500,000 and it turns into $8 billion because retarded Facebook paid way too much money for a dumb technology they'll never use. You're like, I love hearing those stories. Too bad it never happens, statistically speaking. But it's really exciting to give somebody millions of dollars and say, well, maybe it'll hit in 10 years. But always going for home runs, always, to me, as a hedge fund manager, that seems like degenerate gambling. But I can tell it's exciting and you get to brag with all your friends and stuff. But let me tell you about running a hedge fund. First of all, I'm a Forex guy, so we're always completely liquid 100% of the time. 100% liquid. You give that hedge fund $1 million, you'll never see it again unless they're 1 out of a billion. It hits a home run and Google buys it for ridiculous money, or it actually goes IPO. But like Uber couldn't even go IPO for years. Like, oh my God, if Uber and Lyft can't go IPO, like who can go IPO? It just doesn't happen. There's no exits anymore. So you might as well kiss your $1 million goodbye. But let me show you what I can do with $1 million. Boom. First of all, we're liquid. Second of all, income. Third, capital appreciation. 4, I can actually manage the risk. Let me show you. And then all of a sudden, you can kick ass over a VC fund any day of the week. But I need you to think that way. I need you to think down the road a little bit, because if you don't have the proper trading history, aka track record, you're not going to be able to compete. So you can't look like a degenerate gambler yourself. Someone needs to look at your trade history. Remember when I'm talking about if someone looks at all these dots and lines on a paper, they realize it's Mozart, and someone that knows what they're doing can hear the music. Right? All of a sudden you're like, oh, it's clever. I love this. Okay. Your trading history should look something similar. You hand it to somebody and they can read it. They're like, oh, global macro, risk on. Oh, I see what you're doing. That makes sense to me. I can see, right? And those are the people that are actually going to invest. Okay? Nobody invests into dissidents. Okay? So you could flip a coin here and say, okay, I'm long all the time. So do I buy? Look at this. This is why I, by and large, haven't done anything in weeks now. Right? I know you hate this, but I'll remind you. I went on vacation here. I was on the beach. I said, this is it. You got to get out. So I got out. Then I went to the beach. I'm like, look at me. I'm on the white sands. I'm swimming in the waves. It was so cool. The water was so clear. I'm standing there like, oh my God, actually shoulder deep. And I can see my feet in the water. Oh, wonderful, right? So what did you learn in there? Know when to hold them, know when to fold them. Know when to walk away. Cool. So now, look at that. Isn't that ridiculous? That we've gone from, I have to get rid of this now. We've gone from this in a week to this in a week. You're like, holy smokes. I said, by the way, this is where I lose money. I found over the years, when I didn't adjust my my trading with expectations and stuff, I lost money when nothing happened. Look how we went from this period to then tighter period to now even tighter period. Taut. Cool. Now, this will not last forever, by the way. We will get a breakout and all that kind of stuff. But do you know when? I don't know when. I know it's coming. And it might be in a week. It might, right? It might be in a month. It might be in a quarter. Okay? We can guess and stuff, but why even guess? It doesn't matter. Who cares? You can have your opinion, I have mine. It doesn't matter. It'll happen when it happens. Buddha says everything has its time. So you wait. Patience and discipline. But you're waiting, right? But you're observing. You're like a sniper, for example, spends 99.9% of their time with their finger on a pencil. They're observers, and they write everything down. I saw this today. I saw that today. This guy walked by. That guy walked by. The blue car's in front of the house. The red car's in front of the house. The blue car is back. And then 0.1 of the time, finger on the trigger. So we're in that situation where you're all on pencil. Notice how even my daily training with you has dramatically changed from here to here because I'm giving you the message you need, not the message you want. Okay? So now, cool. So you wait. And wouldn't it be helpful that you knew what you were waiting for? Are you a buyer? Or are you a seller? If you don't know that, forget it. Forget it. It ain't gonna happen, bro. Okay? Now, how many amateur traders are throwing down big trades right now because, I don't know, it's Monday or, I don't know, New York's opening or something. And they're forgetting the fact that, like, this is not a good trade. On this, what are market conditions? Remember, the first thing you do besides, okay, your first thing is you have a bias. The second thing is you confirm market conditions. This is how the day trading course, by the way. I actually gave people a list that sits on their chart and says, step 1, confirm your bias. Step 2, confirm market conditions. Okay, is this a good market for buying or selling? We haven't had a higher high or a lower low on a 4-hour candle in over a week. We haven't had a higher high or a lower low on a 4-hour candle in a week. Oh my God, that's amazing. Yeah. Good opportunity to lose money is the way I look at it. Cool. But maybe things are different in other places, right? A little better. Came down a little more. Right on. Let's see. Oh, cool. Now, do you have a reason? A basis? You do now. You have permission because of that. I'm not making a trend out of it. I'm just making a higher low. Okay? And by the way, it's at 119.81. What? 119.1? You may know this, if you're a swing trader, that that's the exact price you want to be long. And you'll say, well, Wayne, it didn't happen on Monday. Oh, I know. It happened on Friday. And the wonderful thing about the tools I give you and the training I give you is you knew that on Friday. You knew it. You already knew it. You knew that. It was factual. You knew that. You knew this week's pivots last week. Okay? And then look at the open, guys. If you were at your charts Sunday at 6 p.m., I know you hate this, but this is the truth, so don't be mad at me. Sunday at 6 p.m., if you were at your charts and you were a bull on this pair because you are a bull on macro econ, okay? Your analysis of macroeconomics has made you bullish on the euro yen. So Sunday at 6 p.m., you're at your charts, you opened here, you bought it, it was long for 4 hours, another 4 hours, another 4 hours, another 4 hours, okay? You're done. You worked maybe 10 minutes this week on this trade. And you're done for the entire week. It's binary now. You're going to go up here and make money, or it'll come all the way back down and you'll break even. Good. Nice shot. But you waste, most likely, I don't know you, I don't know your trading, but most likely you waste a lot of time trying to figure out what the hell is happening. And that's the problem. If you're a bull, you're like, I buy at support, I buy dips. It's that. It's not complicated. You're not trying to figure things out anymore. You're just setting things up. Okay? So you're like, Right? So you're like, we got a legitimate bounce on support, a legitimate higher high, and now I want myself a legitimate higher low. Oh, look, there's next week's pivot. Okay, cool. So I want to buy right around 120. That's it, dude. That was it. That's it. The whole thing. That's it. That's your whole trade plan for the week. Buy a dip, the psychological level of 120. Really? Really? It's not that complicated. It's not that hard, right? How do I feel about hedging? Well, I think my version of hedging is different than your version. So typically what happens with people that don't have the discipline to carry out their trade plan, which means either get out a bad trade or take profit, then hedging is a fool's errand. Okay? If somebody pays me to hedge a position for them, much different. Because if you're hedging a cash position with your Forex trades, that's different. Okay? So if someone has $1 million worth of gold and you're like, well, I'll trade XAU USD for you and I'll hedge your exposure to gold and dollar. Okay, that's awesome. That's a business model. That's a business plan. That's a business, man. Okay? But if you're like, I'm down 200 pips, what do I do? Oh, you should hedge it. No, dude. You should quit. All right. Cool. So, listen to the message, guys. Don't get off topic here. All you had to do for this week, incredibly simple plan, buy a dip to 120. That's it. It follows so many different rules of engagement that it's ridiculous. That's a good look. That's a good shot. Will it make money? I have no idea. I have no idea. This time of year, I concur. This can do that, and you get knocked out, and you had a free look. You're already up 100 pips, almost 140 pips for the day. Remember, we're bitching and whining that the markets aren't moving. Yeah, it sucks, man. I made a trade. 16 hours later, I'm only up 150 pips, right? Okay, that's not a bad day. Now, you could give all of that back on a pullback. Sure. Oh, for sure, eh? But the thing is, you can't control the outcome. The market will control the outcome. But if you're not doing your job, there's very little hope. So how should I set up my pivots on a daily or weekly? Well, it depends on your trade plan, Peter. If you're doing a weekly swing, weekly pivots. If you're doing day trading, daily pivots. If you're doing a position trade, monthly pivots. Remember, there's different styles of trading. Right? It comes down to trade planning. It just comes down to what is it that you're planning. Are you going for 100 pips? Are you going for 300 pips? Or are you going for 1,000 pips? That's one way of looking at it. So if you want 1,000 pips, monthly pivots. If you want 300 pips, yeah, that's a week. We do that all the time in the swing trading group, right? It's just weekly swings. Cool. So, right now we're in a tighter market. So this one is buy it at 120 and you're going for 122. So this sucks, right? This is summer trading. Your plan is worth 200 pips. Now, you don't know if you're going to get it because remember what I said? Plan big but expect small. So you're up 100 and something pips. Okay, so it may not even get here. So you have to make these decisions. Do you jam your stop? Well, I would say for sure your stop should be jammed. And then the second thing is, do you lock in anything? Well, here's how I always think of this and how I explain it year after year after year. You have two choices. Now, in this case, you have 100 pips, right? So that's pretty good. You can, when you're shooting at rabbits, that's a pretty fat rabbit. Do you take that? Yeah, but you have to understand it's worth 200 pips. Okay? Now, if you're on a trade and you only have 15 to 25 pips profit, do you take it? Well, you can, and if you do, it kind of ruins your longer term trade history, but you're producing income. You're not going to get any asset appreciation. This is sort of just income only. You're picking up 25 pips. It pays the bills, but it doesn't do much. But it'll also lower your longer term statistics. So, right, because now you got more and more and more little trades on top of your proper winners, and it'll lower your average your average winner. Now your average loser is going to stay the same, but you might cut down your winners. So let's say your average winner on average is I'll just say it, 99 pips, right? And your average loser is negative 33. Okay, you have a nice little fun. Now, if you spend 2 or 3 months and you're just knocking down a bunch of 25 pip trades, all of a sudden your losses are still negative 33. But statistically speaking, now your winners are only, let's say, plus 50 instead of plus 99. And your track record looks half as good as it used to be. So you have to decide, do you want the income? Or will you maintain, like, you can't even think about taking profit unless you hit 99 pips? Okay? So I would throw away 25 pips. I don't care about that. It doesn't do anything but, I mean, it's not even a lot of money unless you're loading the boat. But statistically speaking, it's not a lot of money. But if you hit 99 or 200 or whatever, if your swings are coming together, okay, well, now, again, it's income. It's not a big winner. It is income. You throw down your let's say, if you get 2% in June or in July, for example, that's a pretty decent July. I'm cool with that. So I'd rather break even. I'd rather get like 0 or get my 2% than get 1% living on, small income, but drop my statistics, right? So you have to make all these decisions, like what do you call income? How much do you need the money? Of course, if you're a fund, you don't need it because it's your client's money. So you're more focused on the longer returns. Nobody expects you to do anything in July, so why should you try? So in that case, now you'd have to make a decision. You got a proper trade. You got 100 pips locked in, okay? Do you move your stop to lock in the 100 pips? Or do you go for the 200 pips, right? So now you're risking 100 pips in opportunity cost. And you might end up with that, and you end up with the 0. right? Or do you go for the 200? And there is no right answer. There's multiple answers. It comes down to your risk tolerance, the risk tolerance of your clients. Um, if you threw down some losing trades last week, you're going to be very interested in taking some winning trades this week. You see what I mean? Like it's always going to be different. So if you're already, like, let's say on between here and here you lost 100 pips, and now you're sitting on 100 pips win. Oh, you're going to be happy to take that. So you had 2 losers here at 50 pips each, or 3 losers in here for 33 pips each. Now you're up 1 for 100. You're like, yeah, I'll take that. Okay. And so what you're going to be interested in is, a normal distribution. Okay, so here's your tails, and here's your scatter plot of returns. So you have some bigger losers, and then you have lots of little losers, and then you have lots of little winners, and then you have a few big winners. And right now, you have to decide how you want to treat this statistically. Over summer, do you want lots of little winners and lots of little losers? Are you going for more bigger winners? Are you willing to have bigger stops? Now, this would be not number of pips, but the money you lost on these trades. So, I mean, you could double your stop, but then cut your lot size in half, and statistically it's the same. But the interesting thing is you might have one trade go for 500 pips, and it's worth 250 for you, so it gets thrown into the right fat tail. Okay? But the interesting thing, so a venture capital firm makes lots of investments, and they're all going to be losers except one. So what happens is you get fat tails, right? So they'll say, well, we'll make 100 investments, 99 of them will lose everything, right? Or some will break even, kind of thing. And then one will get bought by Google. But the thing is, you're like, well, what if one doesn't get bought by Google? Well, then the math doesn't work out, and it's a dumb investment. You would never invest in venture capital. But we're pretty sure we'll hit one home run. I hate that, right? Now, what we do is interesting because it's different. Yes, we have some bigger losers once in a while. Yes, we have a lot of big winners because we just get everything right. But what happens is the big winners go away. Oops, I guess I should leave that. Undo. No, I have to undo this. Okay, so these go away. These big winners. Okay, since your big winners happen, they should happen more often than your losers. You should never have big losers. Okay, so that goes away. Ah, dang it. Oh. Okay, so what happens is your big winners actually pay for all your tiny little losers, because they're 10 to 1, right? So every one winner pays for 10 of these losers, and you really shouldn't have any of these in there. Okay? And your fund is left with this. Consistent returns. Your big winners is not what makes you money. Your big winners pays for all the break-evens, all the little losses, and every once in a while a troublesome episode, right? You might have a couple of troublesome episodes, but statistically speaking, it's an outlier. Like, you rarely have a big stupid loss. Like, it shouldn't be there at all. Maybe it happened once or twice, but it shouldn't be there, right? So you'll just have a boatload of break-evens, which is along this midpoint. And you're going to have lots of negative 33s, negative 25s, negative 18s. So your big trades here, your 500-600 pip trades, your 1,000 pip trades, they're all going to be here. And all it does is take care of all your losses. And now all your mediocre, boring, 50 to 100 pip trades is where all your returns are. Okay? And then some other idiot comes out and says, no, 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 don't give $1 million to Forex. That's dumb. It's a scam, eh? Instead, I'm going to invest into companies run by people that don't know what they're doing with the technology that's not proven. They don't have experience, nor do they have money, nor does the business model make sense. But besides that, we're going to give them $1 million. And we'll just do it to a whole bunch of people. And maybe, just maybe, one of them hits and we'll get a giant fat tail and we'll make $1 billion here and we'll lose 100 million there. Well, statistically speaking, right? The results are skewed. Okay? So you should be able to go up against those guys and beat them if that is what your trading history looks like. Okay? If you can rack up an average of negative 33 pip losses, an average of 99 pip winners, and 60% of the time, who can finish the sentence? 60% of the time? It works every time. If you can do that because you're buying dips in an uptrend. See, if you're buying dips in an uptrend, I bet you anything your results will be better than 60% winners. Okay? If you're buying dips in an uptrend, because that's your bias. That's what you said you do. That's your job description. If that's all you did, I bet you'll have a success rate higher than 60%. But if you do the math, if you can achieve 60% winners, 40% losers, your losers are 33 pips on average, and your winners are 99 pips on average, you will have a real legitimate business worth investing into. Sure, if this goes to 70, even better. But this number can't get bigger, but this can. And this can. And here's the interesting thing, guys. At that rate, okay, if you have 60% losers, guess what? Instead of 60% winners, you have 60% losers. You know what? You're profitable. How would you like to invest into a business that if it goes through a period of more losers than winners, you're still profitable? How many people would invest into a business like that? Even if you go through a tough period where 60% of everything you buy turns from gold to lead, but you still make money. How many people would invest into something like that? Okay. Now, what if someone else comes along and says, would you invest into a deal that won't make any money unless one of them turns into $1 billion? We expect a 90% loss rate. But if we get one thing right, we'll make money. But then we could also get 100% wrong. We expect 90% wrong, but it could be 100% wrong. Okay? So that's who you have to compete with. The thing is, your first investors are obviously not institutional, right? They're rich people you know. They're probably not even high net worth people. They're just like someone that can throw you 50 grand, right? But if you could sit down and explain it to them and say, well, let's talk about the different opportunities. What is a mutual fund? You say, well, you probably already have mutual funds in your retirement account. So what is a mutual fund? You can talk about it. And you're like, well, what is a hedge fund? And you can talk about that. And then you could talk about, well, what is a venture capital fund? With the big VCs and in the San Francisco Bay Area, Silicon Valley, throwing money down, making ooh, great. Well, that's also just a fund. So let's compare a mutual fund, a hedge fund, and a venture fund, and why they're appropriate for different people, how they have different risk tolerances, and in fact, quite different business models. And then how about real estate? Why don't we throw in real estate? Whether you're in a real estate investment trust or you're just going out, like you're not going to give me $1 million, you're going to go out and buy $1 million worth of real estate. Which, if you have $1 million down, you can actually control $3 million worth of real estate because of leverage. Well, hedge funds also use leverage, right? But mutual funds don't. So we can compare all these different things. So who has better liquidity? Okay. A venture capital fund has no liquidity. How long does it take you to dump your apartment building and sell it for cash? You need to raise cash quick. Dude, it could be a year, right? Like you might have to wait 3 days, 3 months, a year to liquidate. So venture capital is not liquid at all. Hey, you can buy an apartment building, and the upside is you have income. You collect rent. You can count that as a cash flow. Awesome. And if you hold it long enough, the value of the apartment building will go up, but it ain't liquid. Cool. So if that's important to you, you have to consider that. Then how about a hedge fund like your Forex fund? And then what about a mutual fund? Obviously, a mutual fund is quite liquid. You can call up and cash out anytime you want. But it's going to ride the market down. And if it goes up, yeah, you can have, you can make 5 to 10, sometimes 15% a year. But you can also lose 5 or 10% per year. So you have to, well, who's that appropriate for? What about this? What about that? What about that? And you start comparing them. And pretty soon your first investors you'll find that instead of giving them a sales pitch about getting rich, you're educating them. And I think they'll appreciate that. Okay? And then you can say, I'll show you in my trade history that even a period where I had 60% losers, I was still profitable. I lost 60% of the time, but I threw down 2% for the month. Huh? Isn't that neat? So how about this? And then I'll move on. I didn't mean to go fundamental. I was going to go through everything, but I went fundamental again. Sorry, it's just the market conditions we're in. Okay, so by the way, are you guys okay with this? What I'm going to explain next is your sales pitch versus a real estate syndicate. Your hedge fund versus a real estate fund. Yeah, we only have 63 likes. So are you guys getting this information somewhere else for free? Nothing about the pips. About the pips. No Ponzi's. All about the pips. All the pips. No Ponzi's. All right. Where was I going to go? Okay. Real estate fund. Real estate fund. Okay. It accumulates income and appreciation, right? Now, there's other things that we do in real estate. So I'm in a real estate financing class right now, so I can tell you, you can there's amortization and some other things you can make money on, which means you get a 5-year mortgage, and at the end of 5 years, you've been paying down your principal as well as the interest, but your principal has gone down. So now you have equity that you didn't have before. And now when you refi, because after 5 years, typically you refi, so you refi the whole mortgage and then you pull all that out, and now you put that in your pocket as profit. And remember, the renters are the one paying down the principal and the interest. So what you do is every 5 years, you're like, you pull out $300,000 and put it in your pocket, or if you're a big player, you pull out 3 million, put it in your pocket. Your mortgage goes back up, of course, but you don't give a crap. You're not paying the mortgage. Your renters are. That's how rich people get rich and poor people get poor. You have 100 renters paying down your principal on your mortgage. So every 5 years, you're like, yeah, I'm going to give myself 3 million. And then what do? Yeah, I think I'll go on a trip around the world. So you go on your trip around the world. You've been gone for 30 days. Boom, the rent comes in. Your management company pays all the expenses. And they're like, yeah, we're going to wire over, $98,000 for the month for you. And you're like, oh, right on, cool. then you're out in Greece for 3 months. And you're like, every month your money comes in. You're not doing anything. Okay, but that's where you want to get. So in general, you collect income from rent, and the value of your real estate will likely go up. Now in Forex, we're also and I'm gonna put in here all over leverage. Okay. And now we invest into things, and we own currencies, which is like a form of like owning a bond. And that will pay us income. And of course, the name of the game is buy currencies, or, gold or oil, whatever asset that we're buying will also appreciate. I'm not even paying attention now. And then, of course, all over leverage. Okay, they get 3-to-1. We get 50-to-1. You might be more. Doesn't matter. At some point, you don't need the leverage, right? If you need 200-to-1, you don't got it. Anyways, so it seems very similar, right? Well, this is illiquid. Illiquid. And by definition, what we do is liquid. It is liquidity. It's money. So we have more leverage. We're completely liquid. And how much are you expected to gain if you invest into a real estate fund? So one of my friends, he has a couple billion, I think. I don't remember. But they have 500 different properties, all multifamily, and I think they own some doctors' offices and stuff. So they have a few $1 billion, right? And they have 500 investors. So every fund gets new investors. So they're all, investors are LPs and stuff. But anyways, so the pitch is 15% per year. Now it's IRR because they only measure the money they throw in, but whatever. So they're promising 15% a year. Okay? So what if you were going to be equivalent? So I think we're less risky because of the liquidity issue. But I love the idea of income coming in, and the value of most of the time, the value of properties go up. So this is pretty good. This is like owning a bond. Now, when you buy a bond, or you're lending a company or a country money, and there's a chance that they might not pay you back. There's a default risk. But you're going to collect income, and then you get your money back. So real estate, I think, is a little like that, where you're going to collect rent, and the rent pays for all the expenses, and then it pays for the cost of borrowing, right? It pays for your loan, and whatever's left over goes in your pocket. And of course, after 5, 10, 15, 20 years, the value of the property goes up and you get your money back and you put it in your pocket, right? So you get a couple of flows of income from there, or one from appreciation and one from income. And we can do that too because we earn interest. And of course, whatever we buy, if you're buying gold or if you're buying euro, you're collecting the appreciation, right? But how do you get to the equivalent? Let's say they're different, but let's say you could argue that we're just as risky. How do you get to 15% a year? What is that per month? Remember, we compound. Real estate doesn't compound. How much do you have to earn month over month to hit 15%? It's less than 1%. It's probably 0.9%. So if you can earn 1%, you'll be slightly better. And they'll say, oh, that's interesting. But I like to physically touch. I like to see the apartment building. I like to meet the renters. I would never want to meet a renter. But how about this? What if you did 2% a month? Then, oh my God, you are going to have people that traditionally invest into real estate, something they know. And they're like, this is interesting. This is interesting. If you're averaging consistently 2% a month, or even 1.5%, you will attract some interest from people with money. And they're like, well, I already own 6 apartment buildings, so let's try something with you this time. You understand? All you need to do to be interesting to be extremely compelling all you need to do, and the reason I'm telling you this is I want you to focus on it. I want you to be extremely cognizant. Like, this is what you dream about at night. If you can produce 1.5% consistently, conservatively, you're much more focused on the consistency part. I want you to think of your fund being like a bond where someone can count on the income and the appreciation that you're earning from your investments with their money. That you're like an ATM machine. You need to be like a cash flow where they say, okay, I give you $1 million, and at the end of a year, there'll be $300,000 in my pocket. Now, you still have the $1 million, but they get the $300,000 in cash. But you get to keep the $1 million for another year. And another year goes by, and they put another $300,000 in cash in their pocket because you're just a consistent machine. What they want from you is the cash flow. They never want you to lose the principal, but they want you to always generate enough cash that they can count on you. And you're simply making $300,000 out of $1 million. The million never goes anywhere. You're giving them $300,000 a year so that you're paying for the gas in their yacht. Because if you own a yacht, $300,000 is nothing for the fuel. Okay? So they're like, oh, well, I'll give you $1 million and I get to drive around in my yacht for free. Awesome. Okay? The question is, are you focused on being small and being humble, focusing on the long term? Are you focusing on low volume or low volatility but consistent returns? Are you trying to make 10% a day or 1.5% a month? Telling you, okay? It's the long game here. The long game says all you need to do is this. Okay? Okay? That's all you need to do. A little better would be great, of course. But you don't have to do 15% a month. That will scare people away. They're not interested in that. Because reward is a function of risk. If you know your calculus, you can do it. You can do risk curves and everything. Okay? Reward is a function of risk, but rich people don't want you risking their money. Okay? Okay? Men have a deep, 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 deep fear of pregnancy. Psychologically, deep, 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 deep fear. It's true. It was one of the basis of the movie Alien, where the aliens impregnate people in their stomach and the alien busts out out your stomach. So when the guy that wrote that movie, he heard that somewhere, like it's a deep problem for men to like, oh, right? You know what another deep, deep, deep fear is? The sound of a tiger. You know that little, not even a roar, just a little gurgle they make? Apparently your brain just lights up. Ching! Humans, over time, have developed this sense of, if you hear a little kind of gurgle growl in the long grass, you run. Run, Forrest, run. Run, Forrest, run! Like, oh my God, your brain just lights up. And the third greatest fear, way worse than death, way worse than public speaking, rich people becoming poor again. Okay? Oh my God, a rich person going poor, that would be a deep, 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 deep fear. So you can't go into the say, hey man, I'm going to make you rich. Well, A, they're already rich, and B, they're much more worried that you're going to blow through and lose their principal. So you're not allowed to ever lose the principal, guys. So if you simply focus on really consistent returns, 1.5% is enough. Now you're like, that's not a lot of money, Wayne. Well, not on your account, but if you had $1 million or 10 million or 100 million, sure, that adds up. But the thing is, it's better than your BATNA. Okay? The best alternative to a negotiated agreement. Okay? So, someone comes along and they're going to make a decision on where to invest $1 million. Your hedge fund or the real estate fund. They like both of you. You're both great. Okay? One produces 0.9% a month, and you produce 1.5% a month. And you show that you've done it over years. So it's not like you did it for a little while. You always do it. Who are they going to pick? The same amount of risk. Equivalent risk. Risk is... Okay, risk is equal. I guess we'll do it this way. Equal risk. Which one do you take? That's all you need to do, guys. That's what you need to do and focus on the next 30 years of your career. So Anthony Liu, I played a trick. Because I threw down one that's debatable, you process the information differently inside your brain. And now you'll remember. Okay? Sorry, but now you'll remember. It's a form of anchoring. You're like, wait, really? The pregnancy thing? That's scary, but really? Is that really true? Oh, but the tiger is, oh, for sure. Right? And then you're like, yeah, going broke. I could totally see that. Cool. Right. Yeah, yeah. How about this? How many people saw the tiger in the grass? Or saw, no, you probably didn't see the tiger. How many people saw the grass and heard the tiger? You could literally visualize tall golden grass blowing in the breeze, and everything is wonderful, and you're like, what a wonderful day. And then you hear that gurgling, growling, low sound of a tiger, and you're like, fudge. Right? Oh, I gotta go. Run! Yeah. Make sure you pull the tiger's tail first. Anyways. All right, so I feel like I made my point. Look at some of these guys. Like, dude, it's on the exact price at the exact time. Like, dude, you either did it or you didn't do it. You can see bears did their job. That was gold. Here's bears had 2 plans. Bulls only had 1. Guess what? Bulls did their job. Bears did their job. Bulls won. Like, where were you? Where were you? No. Anthony, what I was saying is not hanging out with your wife while she's giving birth. I've done that. I've cut the umbilical cord a couple of times. No, I did read it somewhere many years ago, and it had something to do like men having stuff inside their bodies. Yeah, and it's unnatural, right? So like it scares the crap out of men. So, anyways, yeah. Oh, yeah. So, anyways, I'm very grateful for you being in my life. You bring a spark into and an energy that I appreciate. I know how hard this game is. I get it. I honestly do. It's still hard, by the way. I'm trying to prepare you for the next step as well as get you through this step. But I have a feeling if you have a better idea of where you're going, you might be able to handle where you are a little bit better. Okay? And it's easy to fall into the get rich quick sales pitch that might have brought you into my life. And I'm trying to destroy that point of view with a vengeance. With furious anger, right? With great vengeance and furious anger. Yeah. So I am trying to destroy that. And get you on a path to success. That's all. A real path to success. Yeah. And maybe one day because I know you and I know how you trade, maybe I become your #1 fan. Maybe I'm your first client. Maybe I bring you your first client. Hey, we're in this together. We're a team. And I'd like to thank you for being on my team. So peace on earth. May the pips be with you. May our profits be above average. Make sure you pay it back. Go to tradersway.com. Open up a demo account today. Like right now, 10 or 20 people should be on tradersway.com opening up demo accounts. Like right now, tradersway.com. Please like, subscribe, and please leave comments on recordings. because it tells YouTube this is quality content and that they should share it. And this is even better than Fortnite. Okay? Would you do that, please? If you need access to my chart templates, they're in the description below. If you need access to my book, the link's in the description below. If you need a link to Trader's Way, the description's in the description below. If you need the video training courses, still 80% off, the link is in the description below. There's lots of resources I've made over the last 15 years for currency traders simply because they asked for it. There you go. So those resources have been made and available, and maybe you can jump a couple of years ahead through your learning experience. So it just depends, like for example, the video training courses, if it saves you 2 years of your life, is 2 years of your life worth $380? I don't know. Maybe not. Probably. I bet it is. So I'll see you guys tomorrow, and the next day, and the next day, and the next day, and the next day. Only 50% of you had liked this video, so I'd like to apologize. I'm sorry that it sucked that bad, but it's all I have to, so. Okay. The course, $382 one time. 50, it says 35, but I swear there's 50 hours of content. So I'll see you guys tomorrow. Thanks for being on my team. Peace on earth. May the pips be with you. May your profits be above average. And if it didn't suck, click the like button.